Welcome to Impact Pricing, the podcast where we discuss pricing, value, and the profitable relationship between them. I'm Mark Stiving, and today our guest is Lydia DiLiello. How'd I do?
Really well.
Here are three things you want to know about Lydia before we start. She's CEO and founder of Capital Pricing Consultants. She knows a lot about pricing. She has an undergrad and master's degree from Youngstown State University, where Jim Tressel happens to be the president of the university. Go Buckeyes. And part of her career was spent in procurement, and we're not going to hold that against her. Welcome, Lydia.
Thank you, Mark. Go Penguins.
So how did you get into pricing?
Totally by accident. I came out of school with a graduate degree and went to work for General Motors second shift because that was the criteria for being hired. So I actually worked on the line. It was a lottery system. My brother-in-law had a lottery ticket, worked for Delphi, and they said as long as you can pass the physical and you pass the interview, you're in. So myself and 24 other MBAs went in and started working on the line, second shift, plugging wires.
So when you say on the line, you mean building products, physical
Correct.
Factory work.
We were doing factory work, building harnesses for several different GM cars at the time.
With a master's degree.
That's correct.
Wow. Okay, so we haven't gotten to pricing yet, but that was pretty interesting.
So the way we get to pricing is after you spent 9 months doing that, you could apply for any jobs that were available in the offices. And needless to say, I applied for absolutely everything because 3 to 2 a.m. doesn't really work for me. As a consultant, it's fine, but plugging wires, it's different.
Right.
So I got into competitive intelligence. That was the opportunity that was open, and really started to work with a small group of people on the competitive intel. And from there, we actually developed a pricing department for Packard Electric, which grew to be a global concern for them.
Nice. Well, that sounds fun. I've always liked the idea of competitive intelligence and how companies do that. It's super crucial for pricing. So very.
One lends itself to the other very easily.
Yeah, absolutely. So here we are. I'm going to tell you the date that we're recording, everybody. It's March 23rd, which, by the way, happens to be my wedding anniversary. So we're recording on March 23rd, and Lydia and I decided we were going to talk a little bit about pricing in turbulent times, because obviously these times right now are extremely turbulent with the virus. By the time this gets published, we have no idea what the situation is going to look like. With any luck, it'll be over, but highly unlikely. So Lydia, let's talk about this. And one topic that I find so fascinating about any of these is this concept of price gouging. Most people just despise the word. Before I give my opinion, do you just flat hate it, or do you have an opinion?
So I have a strong opinion. I do flat out hate it. If it truly is price gouging. I'm not talking, Mark, about premium pricing. I'm not talking about luxury pricing where you have 6 customers globally and you can name your price. But I'm talking about when there's a need for a specific product, like right now, hand sanitizer and toilet paper seems to be, trading almost about a gold bullion. There was a story in NPR 2 weeks ago about a New York City, a Manhattan company, who was charging $80 for hand sanitizer. Yeah, that I flat out hate. That to me it's predatory.
Yeah, and so I think 90% of me hates price gouging. So don't ever think I'm trying to defend this in any way whatsoever. But if you step back and think about price gouging, it sounds to me like there are 3 main constituents that we have to care about. We have to care about the business, whoever's selling it. We have to care about the buyer, whoever's buying it. And we have to care about society and what's good for society or not. Mm-hmm. And so if we think about hand sanitizer, by the way, I don't get the toilet paper thing at all, but let's go with but let's go with hand sanitizer, because that seems to make sense.
Right. That was a logical parallel.
Yes. Okay. So let's say let's say that I raise my price. I'm a hand sanitizer manufacturer, and I find that I can get twice the price of hand sanitizer that I used to be able to get. Maybe I would increase the number of shifts. Maybe I would move some lines to making hand sanitizer that weren't making hand sanitizer. And so the fact that we're able to gouge, and I say that really carefully, has the impact of increasing supply, which could be good for society while being bad for a buyer. Is that a horrible thought, or is that like dancing on the line?
You know, Mark, I don't even think that's honestly dancing on the line. I think what you've described is good business. I don't think doubling a price and moving manufacturing to capture an opportunity and fill a market need. If hand sanitizer is usually, I don't know, $6 and you're now charging 12, the majority of society can still afford that. It's good for your business. You are giving your workforce an opportunity to earn extra money as well. So when you look at societal gain and you look at the business opportunity, that to me is still good all the way around. When you're talking $80 on a product that was $6, to me, that's the true definition of gouging, rather than, I'll say, optimizing or even dramatically increasing price, if you want to split words.
Yeah, and I would even say the doubling price is gouging if it doesn't help us get more supply. Right?
I would agree with that. If you have 15 sitting on your shelf and you just double it because you can, and there's a market need for that, that to me is where it really starts to walk the line.
Yeah.
If there's no good that comes out of it except profiteering, that's where I start to feel uncomfortable.
Yeah, I think I'm completely with you on that, right? So I think that makes sense. Okay, so let's shift this into more turbulent times, because we've got companies now that are just suffering everywhere.
Mm-hmm.
What types of pricing advice would we give them in these horrible times?
I think first and foremost, I'm always one to say be proactive, not reactive. And legitimately right now, Mark, you could say to me, well, that's nice, Lydia. How are you supposed to be proactive? We don't know what the news is going to bring this afternoon, let alone, in a week. And what I mean by that is, if you've got a strategic plan as a company, Mark, keep working towards that. What's been your company goal? What have you set out there as the most important things for your company to achieve, for your employees to achieve? And then back into that with the reports that you're getting on a daily basis. Companies that are making decisions based upon the welfare of their employees and are, I believe, going to ultimately end up in a much stronger place just through brand loyalty and recognition. I think in times like this, we all remember the companies we hear about who don't do the right thing, so to speak. So in addition to being proactive and sticking with kind of what they've set out as their initial goals and making mindful, thoughtful decisions, don't just say, okay, Wall Street Journal said X this afternoon, therefore by 4 o'clock, we're going to do Y. That I think that devalues everything. And so kind of staying the course is really critical.
Okay. So I think we're going to have to put some examples to this. But again, I think we ought to step back and say, what are the constituencies we're thinking of? So we certainly have the firm and the long-term viability or success of the firm, which is a really big deal.
Mm-hmm.
And then we have the short-term problems of employees, customers. How are we dealing with that whole sales environment today? If you were a restaurant and all you're allowed to do is curbside delivery,
Mm-hmm.
would you lay off your waitresses and waiters?
No, I'd try to hire them on as drivers for delivery if they were interested in doing that. Oh, you said curbside. I'm sorry. So literally, if it's just curbside, I don't think you have a choice. Yes, I would lay them off, because at that point, you simply can't use the headcount that you've got. You have no choice.
Yeah, there's just not enough demand. There's not enough.
No.
Okay.
No.
And so if you're a factory and you're building product and demand slows down, maybe you build a little extra inventory try to
Or
keep
maybe,
people working. Go ahead.
oh, sorry. Or maybe you repurpose for some of the projects that you've had on the back burner, kind of in the same way people are doing with their households. You know, people that are in situations where they're sheltering in place are finding all of those projects that they said they were going to take care of years ago. Any company I've ever worked with has said, well, we've got these two things that we'll get to. Well, if they're things that require labor and you have the resources to do it, get it done now. Keep your people employed, because it puts you in a stronger position when this finishes to come out ahead.
Okay. And so one of the problems that we have, and this happens whether it's a big catastrophe like what we're going through right now, or if we're going through a recession, everybody wants to hold their market share or not lose their volume sales. And so we know the first thing they think of is, well, I've got to lower my price so that I can keep going. What do you think about that? And what's your advice to them?
So I think it's a natural reaction, but we're right back to that reactivity again. I believe that that's not a good thing to do. I think they should not do that. And I feel strongly about that, because what it does is it devalues their brand. What they're essentially saying is, my product was worth $10 before we hit the recession. Now there's a recession, I'm selling less volume, so now I'm going to sell it to you at $8. I think that the brand advertising is all the more important. Continue to sell it at the 10, or find ways to run, quote, specials where you're not changing your base price. That base price remains 10, but maybe now it's buy one, get the second half off for a short period of time, but don't readjust that base price.
Yeah, so I tend to believe that now, especially for the situation we're in now, because I'm hoping that we bounce out of this relatively quickly. A long-term recession, that feels much harder to do, right? Because if I've, it's like going to, Jockey, right? I get the Jockey advertisement in my email every single day for 50% off everything that we have. So guess what? Even though it's a high list price and an advertised discount, I actually know what the price is. It's half of whatever they're charging.
And I think that that's part of the challenge, Mark, relative to when you over discount or you make discounting your standard operating policy relative to pricing. The value's been lost on you now, because as far as you're concerned, your new Jockey price is 50% off whatever they tell you.
Yep.
And if you don't get that, you're not even going to look at it, because you've set a new norm in your mind.
Yeah, that's absolutely right. Absolutely right. And so in the long term, I find it hard for companies in the recession. And some strategies that I really like, could we do more market segmentation? Right? I think companies don't do enough in the world of segmentation. So when you start to suffer and you can't sell your product at the price you used to, could we find those people who absolutely love what we do and continue to sell it to them at that price, and maybe create a different product for different market segments?
I especially like the different product for different market segments. And I would agree with you. Most of the clients I see don't segment at all, or if they do, not particularly well. And I think there's a lot of opportunity there, certainly. And just different value offerings. Change the product a little bit, change the service offering around that product to meet a specific need, gets you away from that comparative pricing.
Yeah. So you could just lower your price. There was air quotes there that you guys couldn't see, by the way. You could just lower your price if you did change the product somewhat. And that says, hey, this is a different product at a different price, so we're not really hurting our value, our brand value. So
agreed. As long as that change is significant enough, not like we see with detergents, new and improved, which is just packaging, and they've used that as an opportunity to raise price 10%.
Yes.
That I think is become very transparent and very, I'll say, an irritant rather than a functional way to manage price.
Absolutely. So what do you say to companies where their competitors have lowered the price because the competitors want to keep their share, or they're not thinking strategically as we go into recessions or any type of turbulent time?
I say change your value offering as fast as you possibly can, and it becomes a waiting game. If you change your value offering it takes 6 months for the competition to keep taking that business at less and less price. They'll gain the market share, but eventually your good customers will see the difference in your products. And if you really do have value and product differentiation, they'll come back to you. But it's going to take 6 months of the competition taking this on before it hurts them enough financially for them to stop it.
Yeah, so we're kind of at the market segment conversation again. So what buyers like us more than they like our competitors? What buyers like our differentiation more than they like our competitors?
Mm-hmm.
Yeah, I find it really challenging because at least when I teach value-based pricing, I teach it in the sense that a customer is going to look at your competitor's price. They're going to look at your price and say, oh, you're more expensive. Are you worth it? And so they start looking at that differentiation in value and in price and comparing the two. So
Agreed.
If my competitor lowers their price, unless I can find a way to make that differentiation even bigger than it used to be, I don't really have a choice but to lower my price somewhat. I don't have to match them, but I have to be in the ballpark in that competitive response area. And so that's where I'd go back again to market segmentation and say, are there people I could keep at the higher price?
And I think that goes right, it's really full circle. It goes right back into value differentiation again, and how much value are you providing, and what extra are you throwing in? To your point about, are you adding more, substantially more than the competition is to offset the discount that they've given? How deep is the discount that they've given? Therefore, how much do you have to add to make up for that in value?
Yeah, so there's got to be something in that equation that's going to make customers want to buy from us again. So, nice.
Well, and I think too, Mark, it speaks to brand value as well. Because if you go in with a really strong name like a Procter and Gamble, something like that has brand equity built into it as well. So you may need less value differentiation if the person or the company dropping the price is not nearly well as known.
Yeah. So although I agree with that, I would also say that if the brand Procter and Gamble was worth more, why weren't they charging more for it in the first place?
My guess is they were thinking that they wanted the market share, so they were going to go after share rather than optimization.
Yeah, too bad. Unfortunately, that's probably true. Okay, so Lydia, we started this conversation out and you gave a set of words and it just struck me as weird, and I've been processing them and trying to figure out how that could have worked in this whole coronavirus world. And you said you think firms should be proactive, not reactive. What could they have done? What could they have done before this virus hit so that they were better prepared for it?
I believe had plans in place, talked through crisis management. The firms that I have spoken to who have crisis management plans in place are further through their thought processes, have been more proactive in general with their employees because they have talked about this as what if scenarios already, rather than firms that have never crossed this and are talking about what ifs while it is live and happening. I think like anything, when there is emotion does not cause clear, concise decisions. It muddies the water, right? Is that a good way for saying that things get really messed up? But if these same questions were asked when there was not an emergency, when there was not a crisis, creativity, thought processes, options, far more than when we add emotion in.
Yeah. So I'm going to quote you. I'm going to create a little quote card with your name on it that says, "Emotion does not create clear, concise decisions."
I should hang it on my wall too. It's true for all of us, right?
Isn't it though? And so when I think about that, as soon as you said crisis management, it's like, oh gosh, yes, of course. But then you start thinking it's only the really huge companies that have crisis management departments. Most small companies, most restaurants don't have crisis management departments. And right. So yeah, I could see that.
Though, I agree with that, Mark, but what I find fascinating is some of these small independents are in some ways I see where I'm at locally responding better than some of these large corporations who I believe would have crisis management departments. And I think it's because what they've lost in planning, they're able to gain in being very nimble and making one decision and sticking with it, good, bad, or indifferent. If they've chosen curbside only, that's what they're doing. And if they've said, we'll deliver and do curbside unless there's a different directive, they're staying the course. Where I think some of these larger companies with crisis management, as soon as you get legalities involved, that's guaranteed to just help those decisions become all the more embroiled and difficult, right?
Yeah, and you know what? Maybe part of the answer there is it feels like smaller companies are probably closer to their customers. So they have a stronger relationship. And so they personally really want to care for their customers. Or I can imagine really big companies, there's so many balls in the air. There's so many different things they're thinking about. Their customers are not the single most important thing to them, which says a lot in a lot of ways.
Yeah, I would agree with that. I think that that's the key to it. Absolutely.
Lydia, this has been fascinating. I have not really didn't really think about a lot of these things ahead of time. So this was a fun conversation. Let's wrap this up with my favorite question. Nothing to do with turbulent pricing. What's one piece of pricing advice that you would give our listeners that you think could have a big impact on their business?
Determine what the single most important thing is that they want out of a business every year. One thing. And then make everything else drive back to it from a strategic standpoint.
So can you give us a couple examples?
Sure. When I work with clients, I have a client who said, we want to grow. It happened to be a large publicly traded. They said, we want to grow our EBIT by 12% this year. Okay. Earnings before taxes and income taxes. So what we looked at was from the strategic overview all the way down through the tactical application with their pricing people, was everything pointed in the direction of increasing revenue and profit to achieve that goal. And what we found was, well, the overall strategy at the exec level was go get that profit. By the time it got down to the tactical level of a pricing person saying, how many discounts did we override this month? How many special price requests did we have? Oh, well, that's that one product, so that's okay. And that was, of course, counterintuitive to exactly what was being asked for. So they were eroding profit while they were giving a directive to go get it.
Yeah, I think that's an excellent example. And it's pretty common for executives to have a strategy that doesn't make it down to the worker level, right? The people that are actually making things happen. So
yeah, I find that very common.
Something we have to test and push on quite a bit. Excellent. Lydia, thank you so much for your time today. If anybody wants to contact you, how can they do that?
So they can do that at lydia@capitalpricingconsultants.com, or they can use my mobile at 330-283-5273.
All right. Episode 65 is all done. Let's see. What was my favorite part? I think the conversation about price gouging at the beginning, because I've just been thinking about that way too much lately, and I'm not overly comfortable with my own thoughts yet. So that was really good. What was your favorite part? Please let us know in the comments or wherever you downloaded and listened to the podcast. While you're at it, would you please give us a 5-star review? These are hugely valuable to us. Don't forget, we have a community where all of the things that I publish show up there. You'll find that at community.championsofvalue.com. If you have any questions or comments about this podcast or about pricing in general, feel free to email me, mark@impactpricing.com. Now, go make an impact.